Hello everybody and welcome to our latest market update. In today's video, we will take a look back at the key developments in the financial markets over the past month. We will also reflect on the major trends that shaped the first 6 months of the year. This video is together with Mario and Chris. Hi everybody.
Hello, hello.
Hi.
So the first half of the year was characterized by strong contrasts. While the first quarter was largely dominated by geopolitical tensions in the Middle East, financial markets recovered surprisingly quickly during the second quarter. At the same time, enthusiasm for semiconductor companies reached almost euphoric levels. Semiconductor manufacturers were among the biggest winners of the first 6 months. Alongside well-known names such as Nvidia and Taiwan Semiconductor, companies like Micron and Samsung Electronics also attracted significant investor attention. Meanwhile, major technology companies such as Alphabet, Meta, and Microsoft have come under increasing pressure as they continue to invest billions of dollars in expanding their AI infrastructure and data centers. Overall, the rally that began in April continued across global equity markets. Technology and semiconductor stocks, as well as the markets in Taiwan and South Korea, developed particularly strong performance. At the same time, we are beginning to see early signs of a rotation into more attractively valued sectors such as healthcare and consumer staples. Bond markets also recovered strongly after a weaker April. One of the key drivers was a shift in expectations regarding US monetary policy. The new Fed chair, Kevin Warsh, has positioned himself as an inflation hawk, making it clear that bringing inflation back to around 2% is his top priority. This strengthens confidence in the Fed's commitment to price stability, supporting bond prices and boosting the US dollar. Overall, the first half of the year demonstrated once again how quickly market trends can change and how remarkably resilient financial markets have become in the face of geopolitical events and political announcements. So let's start with our first question, Mario. How satisfied are you with the market performance during the first half of the year?
I would say performance has been really impressive given the context, given the political context, given the ongoing crisis in Iran, even if it's officially over, but in reality it's not over until it's really over. I say that because the oil and gas prices have come off, but they're still on elevated levels. And I think that gives us an idea that markets are not trusting the current peace arrangements. But if we just look at the performance, we can almost ignore the Iran conflict because global equity markets have achieved double-digit returns. If you look at Korea and Taiwan, you've seen returns that normally only happen in a decade. It's rather remarkable. So it's been a great first half, and especially in the equity markets, with few exceptions. I mean, China is still in the doldrums, and we've communicated our doubts about Chinese equities many times, so it doesn't really bother us because we don't have much China exposure these days. But yeah, global equities have been very good. It's been exciting to see that small caps have finally outperformed the broad market. You know that I've been emphasizing that small caps should be part of a portfolio, but it's been a long wait, but finally it arrived. Emerging markets did well, specifically also value factor investing. It's worked across the world effectively. It's worked in the US, it's worked in Europe, it's worked in Asia. So I think we're really happy on the equity side, and we can see that in client portfolios. On the bond side, things are a bit more modest. Um, we do have positive returns. Money market returns are as expected. Normal duration bonds are actually a bit flatter than expected. That's because of, I would say, still elevated inflation. And interestingly, the long dated bonds or the bonds on the long end have been quite stable, more stable than expected at the beginning of the year. So overall, I think we're quite pleased with where we are. It's also very pleasing to look at client portfolios. I think now that the quarterly reports are going out, people will be happy to see what happened with their money. Clearly, much better than what's happened in global politics.
So you talked about bonds, you talked about stocks, but what about commodities? Like, for example, gold. At the beginning of the year, everyone was talking about gold, that you should invest in gold. What changed over the last few months?
Actually, that's a good point, yeah, because some of our clients have been investing in commodities and gold, maybe a little bit late in, I wouldn't say in the cycle, but sometime mid year last year, and maybe even early in this year. So these positions are currently now on they're down. Um, I would say the main reason for that is clearly the fact that Kevin Walsh comes across as an inflation hawk, which is extremely unexpected. Everybody thought that he would come in as somebody who would look for reasons to lower interest rates, and that's why bonds, especially on the long end, had been selling off. But now that all of a sudden we're dealing with a central bank governor who's emphasizing how the 2% inflation rate shouldn't be exceeded, but rather it should be the upper bound. This is very unexpected, and it means that if you can really pursue this policy and rein in inflation, um, there's less of a reason to buy gold or diversify into gold or diversify into commodities. And I think this is what the market has been playing in the last several weeks. So that's a bit unexpected, and maybe markets were a little bit oversold and a little bit overbought on the gold side. So there was a need for a correction. We've been highlighting that the 200-day moving average for the gold price is quite important, which is around $4,400 per troy ounce, and that's been undershot. So $4,000 was the next support level, and further down, $3,500 would be support, strong support even. But we can see that buyers are coming in around $4,000. So that correction may already be coming to an end or may already be over. We will find out. But what I'd like to highlight to these investors who have been buying commodities maybe a little bit on the late side, if you could argue, um, there was a reason why we recommended this, and I would actually use the current weakness to buy even more, because adding commodities to a diversified stock and bond portfolio made a whole lot of sense, especially since 2020, the period where basically the COVID period and then the war in Ukraine highlighted that the world is different from the period of the 90s and the early 2000s. So we're living in an environment where there is more friction. Countries don't trust each other as they did in the 90s. And this hasn't gone away. And I also think that Kevin Walsh cannot change this just because he'd like to emphasize a containment of inflation. There's so many moving parts which he can't control. So I would actually recommend to people who have been maybe thinking about adding commodities or adding gold but couldn't decide to do it, that this is now probably a great idea to start, or a great starting point. And for the ones who've been buying a little bit, I mean, clearly our client portfolios are, if anything, um, overweight in equities, and we have no clients who are overweight commodities. But whoever has maybe 5 to 10% in commodities may increase this up to 15%, and whoever doesn't have anything, I think adding now a little bit of gold mining, a little bit of copper mining, may be worthwhile. And whoever did it, like what I said earlier, whoever did it since 2020 could emphasize his portfolio returns. So portfolios that have added up to 15% commodities out. Let's say if we're looking at the traditional 60-40 portfolio, adding commodities to a 60-40 portfolio has clearly increased performance. And I think this may continue. I mean, I do appreciate that Kevin is looking to, yeah, to be an inflation hawk. I think the world would benefit from it, but I'm not sure if there's something he can control all by himself. I think this would require much more, how would I say, cooperative behavior between US and China, and I just don't see this. Unfortunately, I don't see this. So yes, commodities, gold mining, gold were a disappointment. Yeah, I don't want to ignore this, even if equities did so well. But given that our client community has such little allocation to these, I'm not worried. I'm not bothered. And if anything, I'd like to add here.
But you already cut this a bit. But when it comes to gold and silver, you would tend to buy not physical, or like tend for solutions like such as Xetra Gold, um, but invest in mining funds, not in physical gold.
Um, I think both is okay. There's a study out of the University of Zurich which says that, or they've basically been looking at equity portfolios, whether equity portfolios on a standalone basis would perform better than portfolios that were adding physical gold to an equity portfolio, a globally diversified equity portfolio. And they found out that adding 10% of physical gold would actually increase the risk return profile of a global equity portfolio. And that was purely done on physical gold, not gold binding shares. And you could argue that whoever owns the world via MSCI All Country Investable Market or via FTSE All World or via Dimensional World Allocation does own a certain amount of gold mining companies and may not need to add to this. But I would argue that at this point in time, gold mining shares are probably as cheap as I haven't seen them ever. They're trading on single digit PE levels. The free cash flow levels are as high as I've ever seen them. And that means these companies have room to either buy back stock, pay out dividends, and so there's a certain amount of leverage vis-a-vis the gold price. So if gold price doesn't implode, doesn't go below $3,500, these companies will continue to be highly profitable. So I think adding them to a portfolio or out overweighting them in a portfolio is probably not wrong. But just buying physical gold can also be a long-term strategic decision. And I would try to buy it close to $4,000, and if 4,000 doesn't hold, buy a little bit more around $3,500. But if, say, the gold price doesn't move much, it stays in range, the gold mining shares may be a better idea, a better short term idea. Long term, strategically, owning gold in addition to equities has proven a good idea.
So I have a question regarding a specific stock because in the last couple of days or even weeks, everybody was talking about SpaceX and how SpaceX will impact the stock markets. And there's some indices that will add SpaceX within the next few days. For example, the Nasdaq 100 or the Russell 1000. And my question is, how will this impact the indices? So, what is your opinion on that? First of all, including SpaceX and how the indices will react, or later on the funds and ETFs.
Yeah, I personally find it disappointing that the Nasdaq Group and also FTSE Russell decided to add SpaceX to their index to their indices as early as now. Normally, they would wait at least 6 months, in some cases 12 months, to add an IPO to their indices. So they're clearly interested in satisfying Elon Musk and his entourage. And just yesterday, I've seen that 60 million shares were traded in SpaceX by midday. So there's clearly a lot of speculation going on. There's a lot of interest. We know that Korean housewives who traditionally were trading all sorts of investments are now trading SpaceX together with their semiconductor stocks. Um, Initially, I was a bit concerned that the weighting in the indices may be a bit too high, but if you look at the rules, they will actually only use the roughly 80 billion that has been placed. Clearly, it's still a big number, but if you compare this number to the market capitalization of Alphabet or the other Mag 7s, it's not such a big number. So the impact on the NASDAQ 100 will be probably as little as about 1% in either direction. So if SpaceX does well, which it currently does. The IPO was a success for now, so it's helping the index a little bit. But at the same time, if for whatever reason, and I think there are many reasons to believe that this stock will not do well in the long term, if it doesn't do well, then the negative impact on the Nasdaq 100 index will be limited. So I think it's disappointing, but I think it's not going to destroy portfolios that currently hold the Nasdaq 100. At the same time, if I mean, we've been talking about the high weighting of the Magnificent Seven for a long time, and we've been advocating our community to switch into stock pickers in the technology space, such as mostly Threadneedle Global Technology, which has an outstanding year. This guy is up 55% and clearly beating Nasdaq 100. So there's no need to own the Nasdaq 100 index if you have access to such a great manager. So we see that money is leaving the Mag 7 to a certain degree. Yes, the Nasdaq has a new speculation vehicle. Tesla has been predominantly a speculation vehicle for the last decade, and I guess SpaceX will be a second opportunity for everybody who admires Elon Musk, and there are many million people who do that. But it'll not destroy the strategy of our clients. So I guess it's a fact of life. There's a lot of manipulation going on in the US stock market, driven also by the government or by the president. I've never seen this before, that such rampant speculation and market abuse has taken place in a developed country. Let's not forget, it's not a banana republic. It's the largest economy in the world, and but it is what it is. And the good news, I guess, for our community is that if you're invested in global equities, you can participate. At least you have a president who wants stock markets to rise. I've not seen other presidents before. It's only Trump that measures himself against equity markets. It's rather unusual, but equity investors can benefit from this.
Yeah, talking about SpaceX, from an investor's perspective, it has felt as though we have constantly chasing trends in the past couple of months. And how, well, are there any sectors such as biotechnology that are currently somehow underrated and worth investing in from your point of view?
Yeah, it looks like markets are moving ever faster. I mean, only recently we spoke about the Magnificent Seven and how they're going to dominate AI. Last year or about 2 years ago, we said OpenAI is going to destroy a lot of business models. Now people are questioning the business model of OpenAI and say Anthropic is the new game in town. Um, it's actually very hard to predict new narratives, I would say. Um, but you can participate in these narratives by momentum strategies, for example. Yeah, if you look at the MSCI momentum index, world momentum, you can see how it's changing quickly. So the large constituents used to be Mag 7 stocks, then this changed into financials and value stocks. Now we see a combination of value and semiconductors. So this is, from my perspective, the best way to play this. You just delegate this thematic investing to a clearly defined, well working momentum strategy rather than doing it yourself. At the same time, if you ask me where could money flow, we see to a certain degree some rebalancing of large institutional investors away from technology stocks and even semiconductor stocks to healthcare, to consumer cyclicals and generally consumer stocks. We've also seen financials doing really well again. And we've also seen small and medium sized companies doing well. So the market is clearly broadening, and that's fundamentally good. And it also shows in our global strategies. If you look at the Dimensional World Strategy, which includes 16,000 stocks, that means a lot of value stocks, a lot of small company stocks, it's actually outperforming traditional MSCI indices by about 3 percentage points. I mean, it's probably best for our community, especially the ones that don't like following markets so closely or don't do stock picking, to just buy the broad market, allow yourself, yeah, to buy everything, buy it via the broadest aggregate, such as Dimensional or MSCI All Country Investable Market or FTSE All World. If you don't want to believe in stock pickers, such as the ones that we also have in our advisory universe, and you'll be fine, yeah, because they have the AI stocks, they have the AI winners, they have the miners, they have the banks, and you'll be safe. At the same time, if there are people out there, naturally we also have such community members who want to see what they should do. If, let's say, they're overweight in semiconductors, what could they do? Healthcare, for example, is a long-term attractive sector, I would argue, but it's currently cheap. But we've already seen some rotation into this, so this probably has a little more legs further. We also see the Indian market stabilizing. It did very, very well into 2024, but has been consolidating last year and most of this year. But the market is now, I wouldn't say incredibly cheap, but it has a forward PE ratio of about 16. I haven't seen it that cheap in a long time, and I'd be very comfortable for our community members to add some India to their portfolios for the long term. Long term, India has been outperforming the MSCI World, the broad market. Another sector, yeah, healthcare, semiconductor, biotech. Sorry, healthcare, India, biotech. Um, and maybe we can start buying the shares of private asset management companies, companies such as Blackstone, Apollo, and so on. They've been hit very hard in the last 18 to 24 months because there's a lot of noise in the private credit space and a lot of private banking clients who don't really know what they've been buying with these products. They're looking to redeem their investments, and that's been hurting the stocks of such companies. And by now we really see what I think attractive valuations, high dividend yields, and we see the market stabilizing. That means there are buyers coming into these names again. And we have two ETFs in our advisory universe that invest in a broad-based basket of private asset managers. And I think this could be something to add to a portfolio. It clearly, let's say if you have too much semiconductors, maybe you can buy some of that. At the same time, earlier we spoke about gold miners, copper miners. These are areas where we see long-term strategic benefit to a portfolio, and where we've just witnessed a consolidation or a correction. So maybe rebalance out of technology, out of semiconductors into commodities, into India, private asset managers, and healthcare, biotech. The broad market is not expensive. So I think it's really certain pockets that we don't want to touch. But the broad market and also small caps are doing well. Interestingly, Germany, our home market, hasn't done anything since the beginning of the year, but seems to be moving a little bit now. Valuations are low. So money is moving from high tech into low tech, or old tech, not low tech, old tech. But again, we wouldn't buy too much Germany in a portfolio, maybe up to 5%.
Okay, so I have one last question for you. Do you expect the second half of the year to look similar to the first half, or what do you think should be expectations of investors regarding the second half of the year?
As you know, I'm not into predictions, but what we can clearly say, if equities have done exceptionally well in the first half, we should not expect this to continue in the same way, because otherwise we'd have another year with 25% performance. I think that's highly unlikely. At the same time, valuations are fine. So I do not foresee that markets couldn't continue a little bit higher, or at least consolidate on these levels. Where I see potentially a little more opportunities is on the fixed income side, especially for dollar investors, because now that, let's say, what is really different with Kevin Walsh, he really says he doesn't want inflation to go out of control. And that despite the fact that there's a president who put him in his job and who's expecting him to lower interest rates. I think this is rather remarkable. This is another mystery of Donald Trump's world, that he's been bashing Powell pretty much all the time, and now there's an inflation hawk in the central bank, and he says nothing. Um, but overall, if the Fed can contain inflation, this will definitely help interest rates. It will help also on the long end. So market participants will be more confident buying also longer duration treasury bonds again. And that's fundamentally good. And if US employment is softening, which it seems to be doing, and hopefully an ongoing stabilization in the Middle East, i.e., lower oil and gas prices, would also help the inflation perception and thereby the bond markets. So I could foresee that bonds will have a better second half than the first half. At the same time, if bonds do well, stocks typically also do okay. So I would say for people, let's just not worry too much about what it's going to look like. Let's focus on what we can say, and that is valuation. And we have created the so-called valuation traffic light on our skyscraper chart, which we will add to this podcast. And if I look at current valuations, they're pretty much in line with long-term averages, with few exceptions. If we the Nasdaq 100, the S&P 500 are expensive and below long-term expected returns. But broad equity aggregates are looking good. Emerging markets is still looking good. Small caps is looking good. Europe is looking good. So a lot of value to be invested in. And bonds are looking in certain ways even cheap vis-a-vis a projected inflation rate of about 2%. So I think it's a good environment. I mean, July tends to be a decent month, probably also because it's a quarterly earnings reporting month. But the period between, let's say, late July and into October tends to be a bit volatile. So people should brace themselves for some volatility. Maybe take some chips on the table if you have a lot of exposure to semiconductors, directly or indirectly. And many of our community members have indirect access via emerging market value, via global value. But we said this earlier in another context. We said, allow yourself to be lazy in financial markets. That means don't think too hard about your portfolio. Set it up in a proper way, and then let it run until your personal circumstances change. And luckily, in people's life, they don't change too much. In countries that we live in, we tend to live in stable countries, tend to have stable lives. So yeah, be lazy in your portfolio and be active and dynamic in your personal life. Maybe that could be a good forecast.
That's a good conclusion, yes.
Yeah, that's a nice advice. So I think we've come to the end of today's video. If you would like to learn more about the current valuations, about the development of different funds and ETFs, you will find our quarterly report as well as our contact details in the video description below. So feel free to reach out to us if you have any questions, if we can help you with your current strategy, with your portfolio, or you have just some general questions. Feel free to get in touch with us. We are happy to help.
Absolutely. We're always keen to have a dialogue, and feel free to just reach out. It's always fun to talk to you.
Okay, so thank you for watching. We appreciate your time and we look forward to seeing you again in our next quarterly video.
Have a wonderful summer. Bye-bye and a great
Goodbye.
weekend.
Bye-bye.